Brad Williams, Frugal Finance, incremental borrowing cost versus a second mortgage. The added cost of borrowing hinges on how much interest rates climb alongside the loan-to-value ratio. With the earlier example, the interest rate rose from 12 to 13%, a 1% difference, as the loan-to-value ratio increased from 80 to 90%. With 0 points charged, the loan held until maturity, the added borrowing cost stood at 20.57%. The extra cost would rise if the gap between the rate on the 80 and 90% loan exceeded 1%. Conversely, it would decrease if the difference were less than 1%. Since borrowers have a choice between obtaining a 90% loan or obtaining an 80% loan plus a second mortgage for the remaining 10%, we would expect the incremental borrowing cost to be competitive with the rate of a second mortgage with the same maturity. In the previous example, if a second mortgage with a maturity of 25 years can be obtained with an effective borrowing cost that is much less than 20.5%, then the 90% loan would not be competitive. This would imply that the 1% yield differential between 90% loan and 80% loan is too great. Lenders have to adjust the differential or the second mortgage rate so that the incremental borrowing cost is about the same as the effective cost of a second mortgage. To illustrate, in Table 9.1, we calculate the incremental borrowing cost for the option discussed earlier, which assumes that the loan is prepaid after 5 years. The exhibit shows how the incremental borrowing cost is affected by the interest rate differential between the rate on the 90% loan versus the 80% loan. A 0% interest rate differential means that the contract interest rate is the same for the 90% loan as the 80% loan, which is 12%. A 1% differential means the contract is 1% higher, e.g. 13% for the 90% loan. When the interest rate difference between loans disappears, the extra cost matches the effective loan cost. Let's say without any additional fees, the extra cost remains at precisely 12%, mirroring the interest rate for the 80% loan. As interest rates climb, so does the supplementary borrowing expense. This added cost rises as fairly consistent rate for each loan. Imagine securing a second mortgage equivalent to 10% of the property's purchase price on top of an 80% primary loan with an effective cost of 20% over a 25-year period. This gets incorporated into Table 9.1. Consequently, for the 90% loan to stay competitive, its price should ensure that the incremental cost over an 80% loan amounts to 20%. For instance, if lenders anticipate an average loan prepayment within 5 years and opt to levy 2 points on an 80% loan and 3 points on a 90% loan, as in our previous examples, this translates to an interest rate differential of about 0.5% or 50 basis points according to Table 9.1. Conversely, if they weigh points on both loans, the interest rate differential would need to be approximately 90 basis points. Differences in mortgages maturity. Difference in mortgage maturities when comparing loan options like incremental borrowing costs versus a second mortgage, it's important to make sure they have similar maturities for a fair assessment. But what if the options not only have different interest rates, but also different maturities? Does this drastically change the analysis? Let's look into this by changing our previous example. Imagine we have a $90,000 loan with a 30-year maturity and a high interest rate. How would this impact our analysis? To find out, we need to look at some key important information first. Here we have a loan amount of $90,000. Payment is 13% over 30 years. Monthly payment is $995. And the formulas, we use payment 13%, 360, 90,000, 995. The other alternative is a 12% loan, 25 years for 80,000, which is 842. The difference, 153. Let's crunch some numbers to get a clearer picture. For a 90% 30-year loan at 13%, the monthly payment comes out to $995. Now, in our example, there are two big differences in the series of monthly payments that matter. For the initial 25 years, If we opt for alternative 2 over alternative 1, the borrower will pay an extra $153 each month. However, during the final 5 years, years 26 through 30, the gap between payments will be the entire $995 payment for alternative 2, since $80,000 alone would have been paid off in 25 years. To calculate the incremental cost correctly, we need to consider the payment difference as 2 annuities or grouped cash flows. Here we're going to have this scenario where we're going to use some factors. And I've been pointing out the annuity factors. Well, this is going to be a MPVIFA, a monthly present value factor annuity. And this will be a MPVIFA, and then this will be a MPVIF, which is a monthly present value interest rate futures. This is the annuity, and just the future value. It's like we're going to find this 10 grand. Here's the formula. This is ugly. This is the way it's done. We're going to have to use this awesome, very attractive looking formula. This thing is a monster. It's going to be these combined. We're going to put this MPV equals 1 plus this, 300 minus this, and then this other MPVIF. So in the end, this is what it looks like. We're going to compute this, which is going to be this number here, this first formula, 1 minus, 1 plus, and then this is trial and error. We're going to have to make sure this number here, this 18846, is tied to this cell. I didn't tie it to the cell because this is just purely for illustrating purpose only. We're going to use this for part 1. Then we're going to go over, and then we're going to use part 2. It's going to be this second one here. I know, it's sloppy. And then the last will be this one here. They're out of order, but just go with it. As we have in the past, we're going to plug and chug. This first factor, then what we're going to do is we're going to take the mortgage payment differential. We're going to multiply 153 by this factor. And it's going to come up with, where is it, 153 times 6302. And it's going to come up with 964206. Going to do this. This other one is going to come up with, and this is kind of crazy. We're going to take these two numbers and we're going to grab this thing. This is that third, and it's going to be 0.0093. We're going to multiply 3866 times these two here. In the end, we're going to add these two together. What we're trying to do is get this to add up to 10,000. It shows right here, edit, cut. Sorry, this is sloppy. Paste. And then we're going to add D83 to D84, and we're going to get 99, which is close enough to, we could probably tune this up a little bit to get to the exact same number. But that's it. What's the point of this? The point is we have to solve for this differential, the 25-year versus the 30-year, 80 grand versus 90 grand. And then where's that other 10 grand coming from? So to equalize this thing, given that the desired present value stands at 10 grand, the answer ought to hover slightly below 19%. Using Excel and solving for the internal rate of return with uneven or group cash flows, this is considered a group cash flow, we get 18.86%. So the incremental cost of borrowing the additional 10 grand, despite the interest rate rising from 12 to 13%, and the loan term stretching from 25 years to 30 years, is approximately 18.86%. This stands in contrast to the incremental cost of 20.57 in the initial example, where no fees were charged and both maturities stood at 25 years. The rationale behind the lower marginal cost in this example lies in the fact that while a higher rate must be paid on the $90,000 loan, it gets repaid over a longer maturity period, 30 years, despite the borrower facing a higher rate for the $90,000 loan compared to the $80,000 loan. There's the benefit of a longer amortization period and thus lower monthly payments on the $90,000 loan. It's worth noting that if the loan is expected to be repaid before maturity, both the difference in monthly payments and loan balances in the repayment year must be factored in when computing the marginal borrowing costs. Also, if any origination fee is paid, the incremental funds paid by the lender should be adjusted accordingly. Brad Williams, Frugal Finance. Thanks for watching.